Everyone knows there's only one thing you need to do to become a successful investor. That's increase your risk.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today what we're going to be talking about is, does high risk always equate to high reward? Typical financial planning will tell you that high risk is what you need to take on to achieve those greater returns. And today we're going to talk about, is that the truth, right? This idea, it's our belief that this idea has been perpetuated for far too long. And in fact, most people have been conditioned to be skeptical of financial choices that actually make more sense.
Great point.
But not to question the options from typical advisors that have poor or unpredictable results.
Well said, Cameron.
Absolutely.
That reminds me of a story.
I hope it's good.
I don't know.
This doesn't have to do with you rolling down a window on a car, does it?
I thought that was a good story, but interesting. Same building that this occurred. When I was a senior in high school, my favorite class was business class.
Okay.
And one of the things we had to do was go interview somebody who was in an occupation that we were interested in.
Okay.
And at that point, I wanted to be a stockbroker. So I didn't have one, nor did I know one. Okay. But a friend of mine's father had one. So he was kind enough to let me come to his office. And what I remember from that day, I remember two things. For one, it was in the nicest building in the city.
Sounds about right.
At that point, it was the Wells Fargo Tower, right at the Howard Hughes Center. And I probably at the top or near the top. And just walking in, I was just at awe of how beautiful it was.
Yeah.
Just the nice tables. Everybody was well dressed. He had a nice suit. A beautiful view of the city out of his window. So I remember that. And then I remember one piece of advice he gave me is, the bigger the risk, the bigger the reward. So this is an impressionable, 18-year-old kid, right? And as you're talking about that, these ideas have been sold to us by Wall Street.
Yeah.
And the government. And here's an example of a guy telling a young kid who's interested in the business that you need to have a high risk and high reward. And also, like, you need to look the part is kind of what it was, the impression that I got, that you needed all these fancy things. But, what I think is interesting, kind of coming full circle of kind of where we're at now. And I think a lot of what he says was untrue. Meaning we don't need to take on a lot of risk, and you don't need a fancy office to impress people. I think your work and your personality and your results should be what impresses people. Right.
Well said. And that's what we're diving into today.
Let's dive.
Let's go.
Okay. So a lot of people say high risk, high reward. Cameron, why do you think people say this?
Good question. I think there's maybe two reasons. There's a lot, but two of them that come to mind. The first one is, right, in your instance, it's usually perpetuated from financial advisors. Man, the first day you walked in there, you're being conditioned to assume that, hey, for me to make any money, I've got to assume a lot of risk here. And I think that the main driving reason for that is because most financial advisors have very limited options that are available to them. Right, is really they've got stocks and bonds being ultra conservative. And then stocks is, man, everyone knows that there's this uneasiness or that there is this speculative nature to that side of the portfolio. And so I think from day one, they kind of start to try to condition people to just get comfortable with that. And so I think the limited options is a driving factor there. And also the other one, I think that's the other idea is that everybody else is doing it, right? And more, maybe better said, is that with high risk is you're not capable of handling that yourself, right, is you got to leave it to the professionals. Somebody else needs to manage this for you. And so if they phrase it that way, right, if there's low risk, man, you could do it yourself, right? But if it's high risk, you need a professional, right? You need somebody that knows what they're doing to handle that. And so I think those are the two reasons that has been perpetuated over the years.
No, what I like what you said is that they're kind of planting the seed or setting the expectation that you're taking on risk and that you could incur a loss. So that way, when, or let's say if you do, the kind of expectation is already set.
Well, you said when, if. I would turn it backwards. I would say when you do, right? I mean, yeah, absolutely.
I was trying to be a little kind of giving them the benefit of the doubt, but you're right.
That was nice of you.
But I will say, Cameron, what you said actually brought up a few questions.
All right.
I mean, for one, if we're going to talk about this, I think we should define what risk is, right? And do all investors and entrepreneurs take on risk?
Good question.
And then I know I'm throwing a lot out at you, so you probably can't handle it. But is there a scenario? I mean, is it possible for you to have a high reward without taking high risk?
Good questions. Well, let's start with the first one, right? First one was, what is risk?
Mm-hmm.
I did some research, right, in preparation for this. If you go to
nice change. That's good.
I know. If you go to Wikipedia, you type it in, like, what is risk, right? The risk is the potential for future loss, right? Or total loss. And so your higher your risk is the higher potential that you have of future loss. And so that is something that I think is poorly communicated, right? I talk about this all the time, and I tell people that words are important.
Mm-hmm.
And so if you just replace risk with loss, I think that rings a little bit truer with a lot of people. And so one of the things that I would say is, when you talk to people on the traditional side, is they're asking a lot of times, like, what is your risk tolerance? Right? So Anthony, I would ask you, like, what is your risk tolerance? How much of your money are you willing to lose?
You want to know what was interesting? When I was younger, I had that expectation set by that stockbroker.
Yeah.
So I kind of went in expecting that I'm expecting to take a loss.
Mm.
But then as I've learned more, I don't want to lose money.
I agree 100% with you, right? As the people that I've met with over the years, my experience, unfortunately I laugh, but it's not funny because I sit down with people over the years, and more often than not, you meet with somebody that's 50 years or older, and man, yeah.
Like me?
Exactly. And the message that kind of starts to come out is, man, if I just wouldn't have lost this money, right? They look back at these investments that were ill advised, right? Poor reputation, but they got into it and they lost money. And really, the idea of risk is kind of managing that downside. And so oftentimes, right, when you're looking at risk tolerance, man, your risk tolerance should be low, which then begs that question is, if your risk tolerance is low, can you find high rewards? And the answer is absolutely yes. And that's what we're going to talk about. But in doing that, you also asked another question, which was, are all successful entrepreneurs risk takers? Anthony, right? I've got some data that I'm going to share, but I'm going to throw this back to you once more, just real briefly. Like, you've had a good career, right? Accounting career, advisory career. I know. But in your career, what's been your experience? Has it been that all entrepreneurs are risk takers?
Now, hold up, Cameron. Let me just soak this in, okay? Because it's rare you give me a compliment on as we're recording. I mean, there's plenty of compliments out after I'm mentoring you, but to do it on camera, I'm just kind of enjoying it. What I would say, and I get my first reaction was, it depends how you define risk, which you already did. But I think the risk that they take is they're doing something different, right? Most people are going to get a job and search for that pension or that retirement plan,
Mm-hmm.
but most entrepreneurs are going a different route. So I think the biggest risk is that they're doing something different with their peers, and a lot of times their parents or friends are not as supportive. But what I found is the successful ones, they're doing a lot of their homework, right? They're finding niches, right? They're not just jumping or just throwing money after things. They're really evaluating the situation. They're evaluating the potential risk of loss and the potential for the reward. So they may be taking risk, but I think it's strategic risk. And there's plenty of times where they're going to fail, but they know that the best lessons are in failures. And so they take those lessons and then they move on to the next endeavor.
Well said. And I want to say something here, because I think I might be blurring the lines between kind of what individuals, right, are getting from traditional financial planners, but then also entrepreneurs. And there is a difference between those two categories, right? I don't think that a lot of investors, right, have or use a lot of traditional products that are out there. But man, I'll tell you what, is I got an email this morning, right? I've been going back and forth with this guy that is a real estate investor, but he's got a bunch of investment accounts, and he's like, hey, I can't quite pull the trigger right now because my investment accounts are down and I just can't do that and this and that. And so I think there's a lot of overlay in our clients. I think there's a lot of people that have kind of a foot in both of these avenues. And so those are the ones that I'm talking to today, right? Is a lot of times when somebody's making that transition from maybe a W-2 job and they're looking at going out as an entrepreneur, is the public perception of an entrepreneur is that they're just these crazy risk takers, right? Is that they're out there, they're a maverick, they're willing to go all in on one deal. But the reality, like you said, your experience and my experience has been something completely different. And when I was researching for this topic, I found a bunch of articles on entrepreneurs, and I found some on Ted Turner. Ted Turner is he's a media mogul, right? And it was talking about how his rise over the years started with him owning a billboard company. He inherited it from his dad. But Ted Turner has this persona that he's just this maverick, right? That he's this big risk taker, and he's a man's man. He's willing to gamble on anything. But one of the articles that I read, it was really, really interesting. And what it talked about is that when he had just inherited the billboard company, he was looking at acquiring another business. And the first one that he came across was a TV station in Atlanta. His accountant and advisor were telling him, do not do this, right? This is a sinking ship. This is terrible. Don't make this deal. He ended up going and buying this. And in later interviews, well, some of the things that he shared on the decisions that he made, that he was looking at when he was purchasing it, was that he actually got it for a really good deal. He got it for like $2.5 million. And there was like $1 million of cash that was still in the business. But the biggest thing was, he said that he had the way that he purchased it was through a stock option. And so he did not have to come out of pocket for the purchase of this company. And he said the second factor that was a big driving force for him was that the fact that he owned a billboard company in Atlanta, and 15% of the time his billboards were unused. So he was able to take and advertise the new television station on his own billboards for zero cost. The other part of it was that the billboard company was just a cash cow, right? It was an income generating machine, but it also had a whole bunch of deductions that were available. So he was able to take some of those and carry it over to the new TV station. So he had all these things that just kind of fell in together. And so what he talks about kind of in later interviews is that it was probably one of the low risk deals that he could actually come across. And so that is what kind of catapulted him into kind of the position that he ended up achieving later in life, of just acquisitions and mergers and everything else, and becoming this big media mogul. But the public persona is the exact opposite on how that whole scenario went down. So
that was very interesting, Cameron. And a couple things that stood out to me was his advice by his CPA and financial advisor said, don't do it.
Yeah.
And how many times do we go to a typical financial planner or to our CPA about some sort of opportunity? And rarely are those two having, I would say, enough experience to give you guidance.
Mm-hmm.
Typical financial planner typically is not going to want you to take their money, that assets under management, and go put it somewhere else, because they're going to lose revenue. And I would say with CPAs, man, they never want to be wrong. Talk about risk adverse, right?
Yeah.
Right. So it's hard for you to get advice from a CPA if it's something that is not extremely certain, right? It's particularly if it's outside the box.
Yeah. Another example that I found as far as, hey, our successful entrepreneurs, risk takers, right? Again, that's the public persona. But man, I read an article, again, it was talking about a 2010 study by a couple that was French. I butcher their names if I shared it with you, but what they did is they charted the course of a successful entrepreneur's career, and they found that almost always there was a moment of great capital accumulation that catapulted that entrepreneur into prominence, right? So there was one event that kind of catapulted them into where they were. And they described this as the entrepreneur having access to that specific deal by occupying what they called was a structural hole or a niche that gives them a unique perspective on a particular opportunity. The conclusion that they came to was that the truly successful businessman or woman is anything but a risk taker. They described him as a predator that seeks to incur the least risk possible while hunting. Man,
That's cool.
I know, I love that analogy, right? Is because, man, that is what my experience has been over the years, but I love the way that they described him as kind of a predator, right? He's out there very calculating, looking for opportunities.
That's cool.
Yeah.
Okay, Cam, those were some great examples, right? But can we become wealthy with more of a low risk, high reward mentality?
Yeah, absolutely. And I think those examples that I just shared were testimonies to exactly that.
Mm-hmm.
And that's what we're talking about today, right? Is you're sharing your experience of what you've seen of some very hardworking, diligent entrepreneurs. And that's what you're going to find, right? Is that there are opportunities out there, and those are the best suited ones for the low risk, high reward mentality. But what does it look like, right? We've said this time and time again, is that where you should invest your money is only invest in things that you know. And that was also the conclusion from that 2010 study that I shared with you is, another way to say that is what local knowledge, right, do you have, or information that you have on an opportunity that would allow you to be successful? What opportunities are you aware of that others are not? The most prime example that I give a lot of times is, if you're a real estate agent and you're in a position of cash, right? You've got cash, available to you, ideally in policies that's waiting, and you're out there selling houses, right? And you come across a house that for whatever reason is being sold for under market value for 20, 25% or whatever the number is. Man, can't you just buy that yourself? Buy that yourself. And even if you just flip it and sell it for 5 or 10% under value, you just made a profit by being immersed in that market and knowing and identifying an opportunity before everybody else did. And so that's the example that this advice or the suggestion that I have for most people is, man, pour yourself into whatever you're passionate about and find those opportunities. And that's where you're going to become the most successful.
Awesome, Cam. I just wanted to add with that realtor, it'd be ideally if they had the cash to buy it.
Yeah.
But just kind of like what you talked about before with these entrepreneurs, where they have this information and this niche and knowledge.
Mm-hmm.
So what I try to tell people, a lot of times people think that they need capital, in order to be successful. That sure as heck helps. But
yeah.
I think the most important piece is your knowledge and expertise and you finding a deal. And if you can put together a good deal,
call us.
That's exactly my example. Money will find you, right? So the important thing is just getting that knowledge and getting that niche.
Mm-hmm. I came across another study and it was talking about kind of the passions and stuff. And I came across this study on social media. I did a little bit of research, and what I found that the study may not, it wasn't peer reviewed, I guess is probably the best way to say it. So take this study with kind of a grain of salt. I think it's got a good message, but don't hold me to the numbers here. There was a study that was conducted and had 1,500 people that were involved, and they put the people in two different categories. Category A said that they would pursue money first and do what they really wanted to do later. And over 1,200 and almost 1,245 people went into that group. Category B, the other 255 people went into and said that they would seek their interests first and trust that money would follow. And what happened was 20 years later, there was 101 millionaires from the entire group, from all 1,500.
Oh, that's a lot.
That is a lot.
Right.
Only one came from Group A. The remaining 100 millionaires all came from Group B, the group that said they would pursue their passion first and let money come later.
That I tell you, I was surprised at those results.
Yeah.
Only one out of almost 1,200 people.
Yeah. What I would tell you is, like I said, is there's a disclaimer on that, right? Don't hold the numbers because, again, it wasn't a peer-reviewed study, but I think the message is important. And when I read that, the thought that I had was kind of, my grandpa's advice, right? Is find a job that you love and you'll never work a day in your life, right? And I think that rings true today, right? That's what our message is right now today, is that the passion that you have is take that and go get into it and exercise kind of your God-given talents in that niche, and the money will come, right?
Awesome. Well done, Cameron.
Yeah. All right. So takeaway. I've got two things. One is I'm going to wrap this up. We're going to look at the perception versus the reality. And then also I've got one closing story that we're going to touch on real quick. Perception versus reality. The perception that is often out there is that people are told to chase returns by increasing their risk, and that people are usually told that, entrepreneurs are mavericks. They're going all in, they're risking it all in one deal, and they're just braver than everybody else. But the reality of that, in my experience and from the articles that I just shared with you guys, is that successful entrepreneurs are rational. They're very analytical, and they are just better at figuring out a sure thing than the rest of us. So when I'm talking to people that are just looking at getting started in real estate, one of the biggest concerns or fears that they have is, oh man, right? I might lose some money. Oh, this is so overwhelming. And one of the things I'll share with them that I've shared on here before is that if you find somebody that's really successful in a niche that they're in, is they've got a very repeatable pattern, a very repeatable sequence that they go through. And we just learn that pattern or those steps that they take, we can come to a conclusion with a very high certainty. And so that is really how we want to do this moving forward. And so that's kind of our message today, is that, right, you just got to figure out things a little bit better than everybody else. Last thing I'll tell you is this whole idea of somebody being kind of a maverick and somebody kind of risking it all is, in my previous life, is I ran caddy programs, and I was kind of around a group that was some pretty big gamblers. And there was a group of, what I would say maybe 15 to 20 runners in town. So what they would do is, on behalf of a gentleman, is they would go out and they would place bets, sports bets, all across Las Vegas, and they'd do a bunch of stuff, right? But there was one gentleman that would come in, and he'd come in weekly, and I'd have conversations with him. I'll never forget one conversation I had with him, as he was a professional gambler, and most of the time he was working on behalf of a gentleman, but placing bets on his behalf. But with his own money, I would ask him, I would say, how do you come up with some of these opportunities that you're putting your money into? And my initial thought, or my stereotype, was that this guy's betting on every game, right? On several games a week, just finding opportunities, toiling away in the sports book, right? And part of that was true, is he spent a lot of time in the sports book looking for opportunities. But so my surprise was that he shared with me, and he said that he might make maybe one, maybe two big bets a month. And that was it, right? He was not out there betting on every single game. He was out there as a professional and he would identify opportunities that maybe other people did not see with certain teams or certain sports, and then he'd act on it, right? And he'd hit that opportunity, then just wait very patiently and wait for another one. And I'll never forget that. That was a great lesson back in the day. But you know what? I think that really what we're trying to communicate to you guys today is that high risk does not need to be had to equate high reward. There are opportunities out there. There's a lot of people that are out there that are taking very low risk and achieving really high rewards in life.
Well done, Cam.
Thanks, man.
You know, in the last podcast we recorded, you made a comment that I was doing all the talking and you were the eye candy.
Yeah.
So it's kind of nice to be the eye candy for once. I'm kind of digging being the eye candy. Well done, Cameron. Thank you.
Thanks, Vaso. Awesome. All right. Hope you guys enjoy this episode.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.